In my last post about trading exits, I pointed out that measured moves occur in markets in virtually every time frame. Now, the reason these are a popular targeting method is because in general, price loves to do things in twos. Double tops are formed by price trying to break up to the upside and failing. Double bottoms are formed by price trying to break lower and failing. Now, these doubles are usually traded by fading the second attempt due to the nature of price doing things in twos. So if the markets do things in twos, could you really consider trade entries on the first move in the direction to be early? Yes and no. In a fast-moving market, many times there's a pullback, and the next impulse move just keeps on going. It happens, and you're going to have to just miss that trade. Many times, though, those that take first moves as their trade entries have the market go against them, stop them out, and they have to re-enter, which helps fuel the trade back into the trend direction. So understanding this leads to our topic, which is trading second attempts or second entries. In this introduction, it's impossible to cover the nuances that are involved in second entries, but let's cover 3 important tips for those that are not experienced with trading them. Number 1, you want to take them with the trend. Number 2, location matters. Number 3, the signal bar formation. So what are we looking for with second entries? Let's take a trend direction of short. We want to see a low in place, the market to rally, attempt to resume the trend and fail, and the second attempt to resume the trend. Now looking at this chart, we can see lows in place and the first and second entries. The first trade may have seen the early short stopped out depending on how far off the high their stop was. Now this chart shows that longs and higher time frames work as well. The first trade entry was the better one using the first entry. The second and third trades both saw the first entries stopped out. So let's take a close-up look at the sequence in this next chart. The H is a lower high in the retracement. Price drops to a zone that held as support previously. You get the first entry followed by a rally and a strong retrace. You get the second entry that rallies 482 pips. Let's be honest here and ask yourself this. If you bought the first entry, would you have exited before taking a full stop after seeing the extremely bearish price action? Clearly, many did exit their trades by looking at the chart. A. After a strong run-up, price trades higher but then closes near its open close to the low. And B. The next day, same thing. Price rallies yet closes below the open and close to the low. C. Price regroups and buyers pile in, which is obvious by the candle with a smaller upper-lower shadow. D. The hammer drops and those longs get taken out with a vengeance. And E, price tries to recover and ends the day positive but with obvious bull weakness. F, the day trades lower, driving more and more longs out of their positions. But other traders looking to sit out first trade entries get a superb entry with a pain-free travel. Now, it's not perfect. Nothing in trading is. However, it'll give you an objective entry point using the fluctuations and the behavior that the markets generally show. There are nuances such as waiting for a bar or indicating the trend may continue that you may want to seek out during your testing of second entries.